Hey all, before we begin, I've got some exciting news to share. We've been working on something a little wild behind the scenes. It's called Unchained On Air, a revamped live stream series and podcast feed that takes you way beyond the headlines. It features sharp, maybe even controversial, takes on major events and the kind of on-chain intel that never makes it to your feed. Way more shows, way more often, each one laser focused on a different slice of crypto and finance. First up is Dex in the City, where the wallets are cold and the takes are hot, with Jesse Brooks, Catherine Kirkpatrick-Boss, and V. Lee. Three powerhouse lawyers gathering to dish about the latest from DeFi enforcement to token regulation and everything in between. It live streams every Tuesday at 12 p.m. ET. Second is Uneasy Money, because what happens on chain never stays on chain, with Luca Netz, Kane Warwick, and Taylor Monahan. Three OG DeFi builders unpacking everything happening on-chain, from tokenomics to DAOs, from hacks to yields. It airs Wednesdays at 3 p.m. ET. And finally, Bits and Bips the Interview, an addition to our group chat show, in which our executive editor, Steve Ehrlich, takes you deeper with one-on-one conversations. This streams on Thursdays at 12 p.m. ET. To catch the live streams, follow Unchained on X, subscribe on YouTube, or find us on your favorite streaming platform now. And don't forget to hit the bell icon so you never miss a show. And if you can't make the live stream, these episodes will show up in your podcast feed the very next day. Thanks, as always, for your support.
I think the key difference is also that, a year ago, when Trump was elected, Bitcoin was trading around 67,000, and we very quickly rallied up 20,000 points or a little bit more within basically a 2-week frame. So there was not a lot of trading between 67,000 to 93,000. So there's like a window here where there's not a lot of support. It's almost like a, like a void really.
Hi everyone, welcome back. Once again, I'm Steve Ehrlich, executive editor here at Unchained and host of Bits and Bips, the interview. Let's take a quick break to hear from the ads who make this show possible.
Are you a builder who needs to add on-chain trading to your product? The Uniswap Trading API from Uniswap Labs offers plug-and-play access to some of the deepest liquidity in crypto. It's on-chain execution at an enterprise level. More liquidity, less complexity. Visit hub.uniswap.org to learn more.
So I'm here now with Markus Thielen, the head of research at research firm 10x Research, a firm that produces daily intelligence and market briefings on everything happening in crypto. And we're here to talk about what's happened in the market, especially in light of NVIDIA earnings, how to trade tactically during bearish times, and also when it's appropriate to call a bear market, and in light of crypto's heightened volatility. So welcome, Markus.
Yeah, thanks for having me. Excited to be here.
Yeah. So let's just kind of dive right into it. Everybody was waiting with bated breath on NVIDIA's earnings yesterday, wondering if they could outperform again and perhaps lift the entire economy, the entire market out of this sluggish pattern. They did very well. What did you see, and how did crypto respond?
Yeah, I think this is probably a temporary rebound that we're having right here for crypto, especially for Bitcoin. Of course, we still have the macro overhangs of a hawkish Fed. We still have the on-chain data that indicates that there's a lot of outflows. Of course, the ETFs are very overexposed right now. We can, of course, go in detail, about those kind of flows, because those were the ones that were really pushing the market lower over the last couple of days or the last 2-3 weeks, really. And I don't think that's going to stop because, people need to clean up their books into year end. But nevertheless, we're coming into actually a period where the RSI is very oversold, where the sentiment indicator is really negative right now. So it's hardly to go negative here because we are already so low. And I think from a technical perspective, we can have some rebound, but the question really is how long is this going to last? And we suspect this is going to be a couple of days, maybe a week or two. But I think then the market is going to worry again about the Fed, and the Fed has indicated there might not be hiking. And I think we have seen the repricing already, of course, from 70% probability to just 30%. So it's unlikely it's going to go much lower, but it's not going to give a lot of tailwind for crypto here. And I think that's why we're coming into the year end, flows clean up their books for institutional investors. And I think that's going to remain an overhang until really year end.
Okay. So let's kind of break some of that down step by step. First, I'd love for you to kind of define a bear market, especially in terms of crypto. I know in TradFi, usually a 20% drop from a local high is sort of the marker. But given, again, Bitcoin and crypto's volatility, that seems to be way too shallow. So how do you define it?
So, of course, I think with crypto, we have to be realistic. The market does not go up all the time. The market swings up and down. And I think the market reacts a lot to macroeconomic indicators. But, to really define what is a bear market, when Bitcoin is in a bear market, I think there's clearly defined on-chain indicators, the MVRV, for example, that we look at. But also there are certain moving averages that indicate when Bitcoin is in a bear market. Can it be, for example, the 12 months moving average, so something like a 50-week moving average, or we prefer actually the shorter period, which is the 21-week moving average. And we backtested this. Every time when Bitcoin is below this level, it is sort of like the stop level where we want to stop out of long positions. And, we came into this period, for example, earlier in the year where Bitcoin broke the 21-week moving average. So if you would have followed this rule, you would have been out of the market, while Trump was really ramping up, the tariff talk. And very similar to last year. Last year, also during the summer, you would have been out of the market. Yes, we're bouncing sometimes up and down to this level. But nevertheless, it is kind of like a rule of thumb, is a little bit more, technical in the sense. It's not just like a 20% drawdown and then we're in a bear market. Because historically, that's usually when we get some Fed reaction function. But of course, that's when the Fed was more forward-looking versus now the Fed is backward-looking. But again, we have, come up with a whole rule book of on-chain indicators when really the market is in a bear market. And based on those indicators, Bitcoin is clearly in a bear market since actually late last month, really, when a lot of those indicators turned, down. And I think an easier indicator that we really like is really the short-term realized price. So which is basically the average price of everybody who bought Bitcoin the last 155 days. And when Bitcoin is below this level, we start to see people being liquidated because, hey, I'm suddenly underwater. I want to, protect my capital, and they're going to get stopped out. And then those people that are underwater and did not get stopped out, they are praying, of course, that the market goes back to this average price. And once the market, attempts to rally above this level, usually we see another wave of liquidations because finally those people, thank God we rallied back to this level. Let me get out of my break-even price. And that's where we really struggle to really go above this line. And we came into this like last year, for example, where the market struggled. We came into this early this year. And again, we are now there as well. And I think that's why sort of like the market struggles here a little bit. But of course, it's a lot of the year-end flow that we're seeing, a little of the unwinding of the ETFs. But, happy to talk about those, of course, in detail as well.
Yeah, so we'll get into that. But I want to just stick on the topic of like comparing this bear market, which you say we've been in for a little while now, with some of the others. You talked earlier this year. I mean, that had to have been around the Trump Liberation Day tariffs that spooked everybody. And then another, I guess, analogy I've been hearing is going back to 2022. And I know Bitcoin hasn't dropped down to like those levels yet, but at least like in 2022, and then again with the Liberation Day tariffs, like there was a clear sort of like driver for this, a clear end for like when the market was going to reverse itself in 2022. It's like when FTX happened, that kind of flushed out the rest of the liquidity. In earlier this spring, Trump reversed some of his tariffs or paused them, delayed them, the whole taco trade everybody was talking about, and that sort of let everyone have time to breathe. This bear market we're in right now, it's hard to see where the bottom is. I mean, there's some bearish factors, as you mentioned. I mean, low expectations for another Fed cut. We had the China tariffs and the massive liquidations on October 10th that sort of drew out a lot of liquidity that I don't believe has returned. And people are kind of really wondering what's next. Is tech still too overpriced? So how do traders approach this particular market when they're not quite sure when the bottom sets in? As you know, nobody wants to catch a falling knife.
Yeah, so the key difference is that for the first time really in 3 years, Bitcoin broke the 50-week moving average. And I think that's sort of like one of the rule of thumbs, how a lot of institutional investors, long-term investors really, base their decisions upon. And, we didn't break it earlier this year. We didn't break it last year. People were sitting on healthy profits, but of course, right now, people are not sitting on so healthy profits anymore. And I think the key difference is also that, a year ago, when Trump was elected, Bitcoin was trading around 67,000, and we very quickly rallied up 20,000 points or a little bit more within basically a 2-week frame. So there was not a lot of trading between 67,000 to 93,000. So there's like a window here where there's not a lot of support. It's almost like a like a void really. And I think that's really like the difficulty when we look back the last couple of months. We had a trading range of 90 to 100, and then 100 to kind of like 116 for many weeks really. And of course, the market has really set its technical levels there. But this time, we are really at a period where there's not a lot of support. As you correctly said, where is really the low here? There is some more liquidity, let's say at 84,000. And I think 84,000 is also like a level where a lot of people suddenly sit really underwater. I think the market right now as a whole is still up around like 20%, but it's actually not that much, right? When you look at, where Bitcoin really came from. So that the true short-term mean of really everybody who bought the last couple of years sits at 83,000. And of course, if we go below it, then of course, a lot of people are going to be underwater. And then I think the next level is probably the 73,000. And as you probably remember, that was really the kind of like the ceiling where we saw last year. And that really stayed really between March of 2024 to really just before the Trump election. And we bounced around, we dropped to 50K, we came back up, but we didn't manage to go above it. So it really seems that this bull market is very different than all the other bull markets because we seem to, trade in a kind of like stop and go environment. There's a big catalyst, we rally up, in a very short period of time, in a week or two, but then we go sideways for a couple of months and a lot of stuff seems to happen, but nothing really seems to push prices up. And of course, as you also pointed out, October 10th was suddenly a really, important event because just like, 2-3 days before, Bitcoin was making new all-time highs. Really, we were at 126. But it was also sort of like a dangerous level at the same time because every time when Bitcoin makes a new all-time high, but doesn't really accelerate and goes back to this level, it actually seems to be a level where it does collapse. So what we want is we want to make a new all-time high on high volume and then a parabolic move. So we want to distance ourselves. And, you might also remember like last year when Bitcoin made the new all-time high in March, and I think it was around like 67,000, 68,000. We went up to a little bit above 70,000, but we failed to accelerate. So there was suddenly not a lot of, money coming into the market. Quite the contrary, with of course a lot of the OGs, a lot of the long-term holders were suddenly liquidating. Probably a lot of people who got into the highs of the previous bull market were really happy to see those levels again, and then really liquidate and really keep a seeding on the market. And I think that's very similar where, we started to make a new high, but then we didn't really accelerate. And I think the biggest example is probably in 2021 when we made a new all-time high in April, then we sold off in May. And that was, of course, the end sort of like of the DeFi narrative. But then we started to make new all-time highs in October, November, based on the whole NFT story and NFT minting. But then, of course, new all-time high, but the market didn't accelerate, and then we quickly collapsed. And I think that's sort of like the worry here as well. But of course, the issue, I think, is a little bit, I think there's a lot of stories to tell. And I don't think the last chapter has been written about this October 10th crash because so many people were stopped out. But I think what's most important, we wrote about it and hardly anybody wrote about it, I assume. But the liquidations on Binance were only 59% longs. And I think that's kind of like puzzling because the market went down, 20%. A lot of altcoins went down 30, 40, 50%. But how come only 59% of the people that were stopped out were longs, right? So instead of shorts, right? So a lot of shorts were stopped out. And I think there's a mismatch between people's trading books that were basically market neutral. they were suddenly stopped out at levels where they couldn't really reconcile the trades.
Yeah, I remember that. I like just like anecdotally, because there were lots of people that had profitable short trades that were stopped out, and they were upset, and obviously they were upset, and some felt that they were perhaps even mistreated by some of the exchanges because of what happened. We need to take a break soon, but I want to just ask you before we do, uh, what are some of the tactical ways that people might be able to trade in this type of bearish climate? You talked about how there could be some brief relief rallies from time to time. Maybe we might even be in one right now in light of the Nvidia earnings. So what are some of the things that people can try to do, and like what's like one or two signals to look for to know when like these perhaps like brief respites might be over?
Yeah, of course, there's, the technical side. There's, of course, the RSIs, the stochastics, every time they're really oversold levels, there's a chance that we're going to rebound. There's, of course, a lot of sentiment indicators. But of course, there's, I think, two kind of very interesting ones. There's, of course, the Coinbase Bitcoin premium or discount. And, since actually end of last month, there's the premium has actually evaporated and went into a discount, which, we can argue that a lot of institutional investors, a lot of US investors really trade, on Coinbase relative, let's say, on the global exchanges relative to Binance. And of course, every time this is in a discount, it probably indicates that more US flows are selling off. So that's kind of like a level where, we have been seeing the discount actually quite steep, but the discount sort of started to narrow a little bit. So maybe there's less outflows. And I think we saw this, on Tuesday, basically, there's a lot, there was actually some net buying despite the market started to go down. So maybe some US investors started to pick a bottom here a little bit. The RSI actually started to turn around a bit. So there is some positive divergence happening. But also something that we noticed was that the skew, so the price or the implied volatility that is used for puts versus calls, which of course was in heavy favor over the last, 5 weeks, really, for in favor of puts, really. So a lot of people were buying puts relative to calls, but that started to actually shift a little bit. So it's still negative, but it's not as negative as it was on Monday morning. So there were some factors that looked actually that on the margin, the market is starting to trade a little bit more positively. And of course, maybe with the Nvidia, story now, Nvidia earnings, so the market maybe looks a little bit more on the positive side because the AI spending boom doesn't seem to be over. And that's kind of like the factors that we look at, just a couple of, top of my head, that is more market timing perspective, because very often in these bear markets, we see rallies of like 10% very quickly. And I think we can capture those rallies up until, of course, the price goes back to some resistance level. And I think the resistance level is around 100,000. So it will be very difficult to go above 100,000, but it still can be a rally, that we can catch here.
Hey, founders and developers. If you're looking to bring on-chain trading to your product, wallet, or platform, check out the new Uniswap Trading API from Uniswap Labs. It's your plug-and-play gateway to global on-chain liquidity. No deep crypto experience required, and no need to manage complex integrations or ongoing maintenance. With the Uniswap Trading API, you'll get enterprise-grade on-chain execution, combining both on-chain and off-chain sources for the most competitive prices. Simply put, more liquidity, less complexity. And this isn't just any API. It connects directly to the Uniswap protocol, which has securely processed over $3.3 trillion in total volume with zero hacks. So stop worrying about liquidity infrastructure and focus on building your product. Get access to the same liquidity that powers billions in swaps through one powerful API. Visit hub.uniswap.org to learn more.
So I want to touch on a few other topics in the news. First, you were a little more bullish on ETH than even Bitcoin in one of your most recent reports. Can you just explain what you saw?
So for Ethereum, we were actually, more bearish. That's actually something that we recommended as a hedge, as a, underperformance against Bitcoin end of last month. So we actually predicted that Ethereum should drop from 3,800 to 2,700, 2,800, because we are still in this negative environment. we were pointing out that, based on some transaction volumes from activity, on-chain activity, that there might be a value level, and we define this value level, below 3,300. It doesn't mean that people should buy, Ethereum immediately if it goes below this level. But if we look into next year, where, for example, we probably have a new Fed chair, we probably have a more dovish environment. So, and of course, maybe a lot more stuff is going to happen on, the DeFi space. If they, the market structure report is going to come out. So I think there's a lot of stuff brewing in the background. It doesn't mean we want to, buy it today, but we want to define where there is value. And the value is not when it's at 4,000. The value is not really coming from the stablecoin market. The value is only really going to come if there's more transactions on DeFi. And DeFi might be a bigger theme next year with the market structure bill. But of course, we don't have this yet. But we just wanted to point people, towards, where is really the level to buy if sort of like the market turns around, whether it's really, more value approaching. Because I think, defining value in crypto has always been quite difficult the last couple of years. I feel like it was a lot easier in the last bull market because there was a lot more revenue. Of course, Ethereum, they switched the revenue mechanics, and, there's a lot less revenue going around these days. But last cycle, we could really define it, certain, NFT minting, generated X amount of revenue, and that usually associated with a price of Y. But this cycle, it's a lot, there's not a lot of revenue because a lot of people are not really using DeFi. The action is somewhere else.
Yeah. Okay. Are there any other tokens that really stand out to you, privacy coins or alts, that have really interesting charts, or sort of like any like overlooked gems that investors might really want to pay attention to?
I think that's a very tough one in this environment, simply from the fact if for example, Bitcoin dominance, grinds up a little bit, as I think it's going right now a little bit higher, while the market cap goes down, it's sort of like the period where actually you don't want to be exposed to anything. And I think it's a little bit surprising because normally in these like sell-off periods, we see, of course, the Bitcoin dominance actually rising more sharply because people selling altcoins and putting the money back into Bitcoin. But I think what we're seeing really the last 1 or 2 weeks is actually people are off ramping. So we saw, of course, that USDC had some redemptions. So that's, I think, a sign that people actually are not going from altcoins to Bitcoin. They're going from altcoins to USDC to probably off ramping. It's small. It's just a couple of $100 million, but it's almost like people don't want to, keep a lot of money right now in the crypto space, because also a lot of the altcoins, they're seeing around like $59 billion of unlocks per year currently. So there's a lot of overhang. And I think a lot of the VCs from the previous bull markets basically have to really liquidate some tokens because their LPs want the money finally back and maybe want to, go all into AI. So I think there's a lot of headwinds for some tokens. Of course, there is momentum, and we are momentum traders in crypto. So if something is breaking out, we are sort of like jumping on it. But, all these favorite of this, cycle, the Ethereums of the world, they're not really great, investments here unless really there's a lot more money coming into the space. And it really seems, as long as the Fed is hawkish, not a lot of money is going to come in. So I think that's why, staying on the sidelines is probably, the right approach. And we don't have to trade all the time,
Yeah, I guess moving money out of crypto to stable is off chain is the ultimate form of capitulation. So that is something interesting to follow. All right, so let's talk about DATs and ETFs, because I know this is a topic that you also watch closely. It's no secret to anyone watching or listening that DATs have been struggling. MNAVs have been dropping. Even strategy dropped below 1 briefly, although I don't know where it is exactly at this moment. But times are really tough, and I'm wondering if you could kind of give me your assessment there. But also, I know that you look at the interplay between ETF flows, which are net negative for a little while now, and how that also negatively impacts, I guess, the ability of DATs to try to begin to raise accretively again.
Yeah, so I think the very interesting aspect, is really, I think there are two really notable points. I feel like, last year in February, end of February, when the market really started to ramp up after the introduction of the ETFs, suddenly MicroStrategy's NAV was expanding, significantly, really from, a little bit above 1, I think 1.2 to kind of like 1.5, and then it's 2 and then higher. And people were really puzzled by this because people expected here's an ETF that trades at an NAV of 1. So why would somebody pay a lot of premium? And of course, people argue that maybe there are some restrictions where people cannot buy ETFs, but they can only buy these companies really. But we have a slightly different theory. And the theory is really that once Bitcoin went above $45,000 per Bitcoin, which is literally, the average price of a car in the US, which is an average first year salary, people actually thought, Bitcoin is actually quite expensive and, I cannot really afford to hold Bitcoin. And I think there's some psychology, going on here where people sort of like just bought sort of like the cheaper alternative. But of course, the whole DAT trade, they don't really use a lot of free cash flow to buy additional shares. They use basically, the NAV premium. And when we came into the summer this year, we are expecting that actually the volatility would decline a lot. And with a decline in volatility, the right tail probability of higher returns were actually also diminished. And I think that really, coincided with the NAVs really being compressed. And of course, there was not really a lot of ability to raise more capital. So not a lot of more capital were coming into the space. And I think that's where sort of the theme ran out. Really for the DATs, because there's no really real story about generating some additional yields. I think they have, of course, a big balance sheet now, especially MicroStrategy, and I think they should become more like hedge funds in the sense that they're selling, upside calls, because you can generate 15 to 20% yield with, these overwriting strategies, and I think there are some other, tools in the box really that they can, bring out, but it's no longer waiting for a retail euphoria and then selling high shares, telling a great, story, because I think retail, has been, burned a lot. So we calculated that MicroStrategy raised around, $45 billion since August 2020, and around 20 billion was really raised with an NAV above 1. So basically retail investors who ever bought, paid a premium of $20 billion in total. And as you correctly said, the NAV is basically back to, around 1. So basically $20 billion has been literally evaporated, into nothing really. And I think that's kind of like a loss that a lot of people probably question if this is the right strategy for them to invest again. And I think we saw something similar in Japan with MetaPlanet, where, people were buying the shares at an implied Bitcoin price of 800,000 USD. And of course, now we are sort of like materially lower because the NAV is also, below 1. So basically, a lot of money has been lost there too. And I think that's why it's very difficult to restart this narrative. But I think it brings also like very interesting concept because, that Ethereum had around, $10 billion of inflows year to date and for the Ethereum ETF. But they were only really in July and in August, and there wasn't really any material inflow before. There wasn't any material inflow after. But we're seeing, of course, this month a lot of outflows for the Ethereum ETF. And I think it's really the question now that because the futures traders, especially the perpetual futures traders, almost like the crypto native people, they were literally all stopped out, on October 10th. So basically Bitcoin is down year to date. Ethereum is down more than 10% year to date. The futures traders are basically sort of like, neutral, relative, if you compare really the change in open interest where we are currently versus where we were on January 1st. So basically, nobody is long except really a lot of the ETFs, and the ETFs, the Bitcoin ETFs, they have net bought, around like 23, 24 billion year to date versus the Bitcoin price is down year to date. So it's definitely some over allocation. And it's not that the 13F filings really make a lot of, the Harvard endowment funds or some of the institutional investors really look good here if they have increased their exposure, because they're looking actually not so great now because the price has gone down. And very similar with Ethereum, because Ethereum, a lot smaller market cap, But here, the ETFs are net long $10 billion year to date, versus Ethereum is actually down 10%. So that's why we were arguing over the last 2-3 weeks that we're probably going to see more outflows from the ETFs, because people need to be, adjusting their books. And if you are a multi-strategy investor, you're having some stocks, you're having some commodities, you're having some crypto, and then you're sending out your statement to your investors, and they look at your statements like, oh, you're long, $1 billion in Ethereum ETFs, but Ethereum is down 10%. It wasn't a great move. Why didn't you buy more QQQs? Why didn't you buy more NASDAQ? And I think that's something like the story that institutional investors want to get ahead, and that's why they're probably liquidating some of their portfolios, and that's where we're seeing this sort of like selling pressure now in the market.
Okay. Just quickly, last couple things. One, with the rise of staking ETFs, how does that impact the debt calculus? I would imagine it like makes their theoretical hurdle rate now much higher, and I know you also pointed out some hidden costs that may not be apparent to investors that actually lower the yield or premium that people might get from buying some of these debts. Can you just walk us through that quickly?
Yeah, I think when we go back to the last bull market, which was of course extremely exciting, because retail investors were basically getting 4 to 6% yield on their crypto holdings, and of course the BlockFis of the world, they were generating 8% yield, and they were generating this yield really through lending to Three Arrows Capital or through Alameda research, really, who really took billions and billions of dollars and leveraged it up. So it was really, they were willing to pay high yields, and they were passing some of the yields down. And back then, the treasury yield was at the low 50 basis points. It was trading more between 1 to 3%. So there was a huge arbitrage, for even institutional established players, taking TradFi, interest rates really, and deploying the capital in crypto. And I think that was the yield arbitrage that was possible. This cycle right now, of course, we're having the Ethereum staking yield, at 2.85% versus the 10-year treasury yield at 4.1%. So there's, of course, negative carry for anybody in TradFi. And I think that's why, the staking yield right now is not that attractive. And I think when you look at, for example, Coinbase, they only, I think, pay 1.8 or 1.9. So there's even, a lot more cost involved there. So in the end, investors sort of like, are they really going to give up more than 2% to stake in Ethereum that is extremely volatile as collateral versus the TradFi market? Maybe, but maybe not. And maybe that's why we're seeing a lot of unwinding in Ethereum staking, per se. But, as you correctly pointed out, if, for example, BlackRock can push through their ETF staking for Ethereum, and they're currently charging only really 25 basis points, and they were actually charging, I think, only 12 until the summer, until they get a certain AUM really for their, for the Ethereum ETF. So that's, of course, a lot less than what some of the other, the DATs are basically proposing, right? So, of course, it's not really transparent. So we're not really so clear what the costs are, but a lot of the DATs have, 10-year contracts with the strategic advisor, and the strategic advisor usually gets, 1% of the AUM per year. So that's a cost of, 100 basis points. Then management gets also, paid, for their compensation, basically. And then, of course, there are some other hidden warrants and hidden costs where some optionality where management can buy out, 5% of the shares, for example, at a really fraction of the price. So that's kind of like all these costs. And I think these costs can easily add up to sort of 1.5 to 2%, depending on, which DAT you look at. And I think that's sort of like a hidden cost that people are not really aware of because they're not really publicized. There are, of course, a lot of SEC filings, but it's very difficult to go through. It's not really clear. We have tried to go through it. But nevertheless, I think when you look that, that you buy a lot of the DATs, initially before at the premium, why should you buy it at the premium when you can just buy it at an NAV of 1 and then probably get your staking yield as well? And I think because BlackRock is, of course, a huge player, they probably get, a fair price really for, for their staking yield that they're going to pass on because they want to be the, one of the low cost ETFs. And I think that's why they were so successful and raised so much capital year to date. So I think there is really this big shift happening. And then one of the key arguments that a lot of the dads were playing might not actually be valid anymore for next year. So there might be also some story. And I think, if I may add one more point, because it goes, to our Ethereum comment like earlier, so far we have not seen that BlackRock was pushing the Ethereum narrative. Of course, we have seen Larry Fink on TV quite frequently, has slowed down a little bit, but, Bitcoin is digital gold. And there has not really been a narrative around, Ethereum. And we're waiting for, the marketing department of BlackRock to push this story. But once they push this story, we might get a little revival in the DeFi story. And I think that's why there might be a level where we want to buy Ethereum. And we want to be looking out for that, but we need kind of more the macro indicators to turn around first.
So thanks for all that, Markus. Before we wrap up, I just want to see if you have any final thoughts and anything that was kind of left on the cutting room floor, any contrarian opinions that you're itching to get off your chest as we move into year end.
Well, I mean, year end is, is almost there. So I think, we're not going to see much. We expect actually the Fed will stay on hold in December. I think that's not the news that we crypto investors want to hear, but, we just have to trade with whatever we get. And then I think, even in January, it's not going to become so clear as well, right? Because, the Fed doesn't have economic data. It doesn't really seem that even like the employment data is as weak. Besides some, of course, anecdotal layoffs here and there. But it's going to be actually a very tough narrative unless really the Fed starts to shift a little bit, dovish here. And I don't think that's going to happen. And of course, then we're coming into, next year. And next year is really the fourth year of the Bitcoin cycle. And, we don't think the Bitcoin cycle has much to do really with the halving. But, nevertheless, there is this, fourth year where Bitcoin tends to be weak, and this year was supposed to, of course, be a positive year. So maybe we still finish a little bit marginal in the positive side. But, the human psychology, the human life is really built on, on really these four cycles, right? 4 seasons, 4 quarters, I think there's also, spiritually, a lot of the signs. So I think when you look deeper, there's a more meaning in this sort of like fourth year where things need to reset itself. And I think that's why we're a little bit worried. And that's why we think actually next year will also be a tough time. And it might be that, we're seeing, a low earlier in the year and then sort of start to rally because, the Fed is going to turn dovish. I think that's, almost like pretty clear. But the question is, are we going to be then at 84,000? Are we going to be then at sort of like 73, 75,000? At that level, it's probably very, interesting levels because, again, if BlackRock files a staking ETF now, that means they're going to get ready. They're going to get their marketing and their salespeople ready for next year. They're going to push this product. I think there's no doubt. So as always, there's a lot of stuff happening in crypto. But right now, the macro headwind is, still forcing us to be a little bit on the sidelines. But I think there's still some great opportunities next year.
Great. All right. Well, thanks so much for joining us. We'll have to have you back. Thanks to everybody for watching and listening. And we will be back next week with another episode of Bits and Bips, the interview.